Well, the S&P 500 ended last week at a record for the first time in a couple of years as a soft landing remains on the cards amid another week of strong US economic releases, albeit that rally came as markets continued to hawkishly reprice their policy outlook, with front-end treasuries notching their worst week since May of 2023 as the two-year yield nudged north of 4.4%. That sell-off in the bond market, though, pushed the dollar to a third straight weekly gain and the dollar index to its best levels of the year so far, as markets look ahead to another busy week this week, including policy decisions from the Bank of Japan, the ECB, the Bank of Canada, and the Norges Bank, plus another busy calendar of economic data, and of course, the continuation of Q4 earnings season as well. Plenty, as always, for myself and Ryan Littlestone to get our teeth into on the trade-off this week. Without further ado, let's get on with the show. So plenty of intrigue in the financial markets last week, and looking at the calendar for the week ahead, plenty of intriguing events likely to come in the next 4 or 5 trading days as well. Joining me, as always, to try and make sense of things is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, I wonder if this week's episode of The Trade-Off is going to run 15 minutes over time and then have an unexpected late twist at the end of it, as a certain football game did over the weekend.
Here we go. Here we go. He's off already. Let me guess. Arsenal had a win for once, and you're crowing about it. Well, it's only going to go over time, really, if you blather on as usual about the usual stuff. S&P, no doubt, is making an appearance, but no, actually, that's me this week again. So yeah, I'm taking it. Yeah, it's going to go 20 minutes over now.
Well, there we go. With a strong start early doors, Mr. Littlestone has decided that attack is the best form of defence this week, exactly. And I think that's probably a pretty sound strategy. Well, we don't want to run 20 minutes over time, so let's roll into Topical Thunder and get underway. So where to start? Well, Ryan's going to end the show talking about the S&P 500. But before we get there, I'm going to start the show by talking about the S&P 500, because we did see a record high in the S&P on Friday. We saw a record high in the NASDAQ 100 as well, with tech continuing to lead the charge higher. That is, just to put some numbers on it, as I said in the intro to the show, the first record high for the S&P since all the way back in early January of 2022. It also now represents the 11th weekly gain in 12 weeks for the S&P 500. And if you look at the market breadth, if you look at the number of stocks making new 52-week highs, that is now at its highest level, or it was on Friday, at its highest level since mid-December. In fact, the day after the December FOMC meeting, when Powell made that perceived dovish pivot. And I think it's a promising sign for equity bulls, at least, that actually that rally has come despite the fact that treasuries are selling off, despite the fact that yields have been rising across the curve, led by the front end, as it speaks to actually the market perhaps becoming a little bit less rate sensitive than it has been in the past. But I think there is probably a little bit of concern out there that the market is almost priced for perfection at this point, in terms of a very, very narrow path towards a soft landing and the roughly 25 basis point rate cuts that IAS now implies by the end of this year. It must be said that the data is still supporting the notion of a soft landing. Retail sales last week, the control group measure, which feeds into the GDP basket, that rose 0.8% on the month in December. Inflation expectations per the University of Michigan survey, that was at their lowest level since 2020. But I do think that there may be a few out there just starting to get a little bit worried that the market may be becoming perhaps a little bit detached from what we see in terms of the Treasury space and in terms of the likely path that the Fed are going to take this year. But having said that, given the way the market shrugged all of that off last week, I think the path of least resistance, for now at least, likely leads us higher into that next Fed meeting on the 31st of January, next Wednesday. But of course, we've got a busy slate of corporate earnings coming through over this week and next, particularly in terms of those magnificent 7 stocks that powered the market higher last year. And I think that is, we need some solid reports and some decent guidance from those firms to really give the market its next leg higher.
Yeah, very much so. And I think this is one of those times where, a lot of people have been looking at the Mag 7 as being one of the main drivers, but now it seems like the rest are catching up and there's a bit more appetite for stocks generally. So this is, like you say, I think this is going to continue for a while longer. The question's going to be, where's it going to stop? Whenever a market takes off, you always get the bears coming in and trying to pick the tops, and then they get burnt and burnt and burnt. And at one point they'll be right, obviously. But I can't see where this stops for the moment. There's quite a few factors that I think are playing into this, just aside from the soft landing, and I'm going to talk about that regarding the Nikkei in a while. But there's definitely lots of little pieces going on that are making up the bigger picture. Whether that continues or not, as I say, that's the question. But for now, as we're saying, trading, the trend is your friend, and I see no reason why it should stop at the moment.
Absolutely. That certainly is the phrase that the market is latching onto at the moment, and looks like it could do for some time to come. In any case, there seems to be, the activity side of the US economy is holding up pretty well. What about the labour market? Is that holding up as well as the growth side of the equation?
Yeah, well, the jobs market we know has been pretty solid. Even when we think there's going to be a wobble, there's not. We had jobless claims data last week, which came in pretty good. Early New Year numbers, so maybe a little bit of skew in there as well. But that didn't flag in that there's going to be any problems in the early start of the year. But I have been seeing a bit of a trend in the jobs market itself, not just the US, but globally. Because one of the outcomes of watching and listening to hundreds of headlines every day, and for many years, is the ability to pick up on trends. Sometimes you hear a headline or read a headline and it means nothing. Then you hear a few more and a few more and a few more. And over time, when you hear the same thing coming out on the same subject, it just triggers in your mind that maybe something's happening. And that exact effect is happening in the jobs market. For the last few months now, particularly the latter part of 2023, I've been hearing of job losses here and there, but things have started to pick up in January with some big names announcing cuts. If we look at the list, we've had job cut announcements from Macy's, from Bosch in the auto sector, from Shell, Google, Amazon, BlackRock, and of course Citi with a big 20,000 job losses expected. So right now, the numbers aren't suggesting that anything massive is happening or any real problems are happening. Maybe some firms are just sort of trimming some of the fat. For example, Macy's, they lost 2,350, so not a huge number. Bosch, 1,200. Shell, say a few hundred. Google, it's in the hundreds in advertising and other roles. Amazon, it's a few hundred in their Prime Video and Audible. BlackRock is 600. So, Citi being the outlier with a big number, but really it's not suggesting that we're going to see an imminent collapse in the jobs market. But it's the trend, I think, that's important at the moment, and that's what's striking me the most, hearing more and more and more about job cutting rather than higher employment and firms, taking on staff. So the fact that these are big firms means that the ripple effect can be a bit greater down the chain. If a big firm like Google is cutting jobs, maybe they use some third-party firms for part of that sector. And now those firms have got to start cutting jobs because they've lost that business. So it can cause a bit of a ripple effect. As I say, I don't think it's something we need to worry about and panic about right now, but it's a trend we need to keep an eye on, especially if those numbers start getting bigger.
Yeah, I think it's a very good point. And actually, the point you made in terms of just anecdotally, you get a feel or you kind of get a vibe for things when you're plugged into the market for 12, 15 or more hours a day is a very, very good one. I think we've all experienced that in the past. And yeah, I would certainly agree with you. I think the bear case for the labour market for some time, and this isn't necessarily something I particularly subscribe to, but it's been that there's this desire among corporations to almost hoard workers. We've heard about skill shortages for quite some time now, and almost a case of, we don't want to let anyone go just in case we can't get these skills back quickly enough. But that sort of has perhaps the net effect of when you do see the labour market start to weaken, it'll be slowly, and then all at once. And I'm not saying that's exactly what we're going to see now, but I think that's probably the worry as we move through the remainder of 2024. If you are in the sort of hard landing camp, then that is what you would be expecting to see as the year progresses. I think there's obviously a few sort of idiosyncratic stories going on. City, for example, you mentioned they're going through a massive corporate restructuring program. So sadly, it's inevitable that layoffs are going to be a part of that. BlackRock, yeah, they announced layoffs, but they've also said at the same time that the firm is going to have a higher headcount at the end of this year than it did at the end of last. So the net effect is almost positive there. But yeah, I think it is certainly a risk, although it's not showing up in the hard data just yet. Initial jobless claims are at their lowest level since, February 2022 from memory. I was talking to Richard Matthews about this towards the tail end of last week, and everything seems to point towards the labour market remaining tight. As we said pretty much this time last year, the question is, how much longer can that last?
Well, it is, and it's still lasting. So I think that the time it turns is when we're all too complacent that it's not going to turn. So we should stay cautious for foreseeable. But you're right, and some of these job losses are, sector specific, like the Bosch numbers. 1,200. That's in their automated driving portion of their business. All the AI and cars driving themselves hasn't taken off as they expected, so they're cutting jobs there. Ford doing the same. Only announced this morning they're potentially moving around 1,400 jobs in their F-150 Lightning range because the EV market isn't picking up. So there's all little bits and pieces behind the scenes as to why these job losses are coming. But if they start mounting up, then perhaps that's time to call a turn in the jobs market.
Indeed. As long as we don't get an AI version of the trade-off, then I think we should be all right. Yeah,
someone in the replies on Twitter last week said you look like it's AI generated.
Really? Well, I can assure you I am real. I'm not sure how I can prove that in this age of AI and deep fakes, but yeah, I am a real person. Sorry to dispel any rumours. Let's be honest. If you were going to create an AI version, you'd give it a prettier face than this, wouldn't you? In any case,
definitely.
You were meant to agree with that, right? Let's move on, because it is a busy week of monetary policy decisions. I know everyone has missed the central bank bonanza, but the funfair has come back around for its first outing in 2024. 4 G10 central bank decisions this week. The Bank of Japan kicking things off in the early hours of Tuesday morning. In fact, we will have heard from the BOJ by the time you watch this video, most likely, but we're not expecting any major shifts there. And as I say, I think every time they come around, I certainly won't be staying up for it. In any case, as we move on to the remainder of the week, on Wednesday, we then move into the Bank of Canada. The BOC should keep rates unchanged at 5%. I think it's probably a little bit too early to get any sort of significant dovish pivot from the BOC. If you look at the most recent inflation metrics, core CPI actually came in a little bit hotter than expected in December, so I think that should temper any dovish expectations there. The Canadian dollar OIS curve prices the first cut, 25 basis point cut for June, which feels about right to me. And then moving into Thursday, we've got a couple of decisions. Firstly, on Thursday morning, we've got the Norges Bank. Obviously, they surprised with a 25 basis point hike in December. As we covered in, I think, last week's show, the Norges Bank seem rather concerned with the valuation of the Norwegian kroner at the moment. So I would expect them to remain relatively hawkish. Recall that they have penciled in another rate hike to come in March. So the question is really, do they signal that once more, or do they take that out of their forecast? And then we wrap up the central bank bonanza with everyone's favorite permanent central banker, unless you work at the institution, that is, which is, of course, the ECB. And we've had pretty much every ECB speaker who has said anything in front of a microphone this year has pushed back on the idea that markets are pricing cuts at one point as soon as March. I think the first cut is now fully priced for roughly April, May time. But of course, Christine Lagarde, the president, doing her best to try and unwind some of that hard work last week by getting in front of a microphone herself and saying that a cut is likely by the summer. So we will see what sort of a shambles she makes of her press conference. We will also see whether the market actually listens to any new guidance that we get from the ECB, who incidentally are almost certain to keep rates unchanged at their current levels. So, Ryan, the $1 million question for you, mate. Which of all of those do you think is likely to be the most exciting, the most intriguing, and perhaps even elicit the most market reaction?
I think it's probably going to be the BOJ. We've been speaking about it a lot on here. Very little expectation, almost zero expectation for any sort of policy move, which then makes the little percentage that they might do something sort of even bigger, because if they do something, it's going to be a big move potentially for markets. So with no real policy change coming, really the only surprise might be if they do something with YCC, call it a day, or indicate they're going to call it a day. Aside from that, it's going to be listening to the rhetoric to find out if they're still on the same path towards tightening. Obviously, looking forward to those wage increases potentially to come. And if nothing happens there and nothing untoward happens on inflation, they should stay on the path. But what's important is it is a forecast meeting. And there's been a few headlines about potentially bringing down those forecasts, particularly from inflation. So if they come down a bit farther than the market might be expecting, that's going to put a dovish slant on things. Conversely, if they stay as they are now, maybe even go higher, then that's going to put a hawkish slant on. So there's lots to come from that, from the Bank of Japan. The ECB, it's funny you mention it because I did a little count up last week of ECB members, and to the point I did the post, I think it was Wednesday or Thursday, we'd had 18 out of the 26 ECB Governing Council members speaking, and pretty much all of them are pushing back on early rate cuts. The consensus is that it's going to be middle of the year, sort of end of Q2, beginning of Q3. And as you rightly said, Lagarde, the previous Friday said she's not going to talk about timing of rate cuts, and then came out last week and said, we're likely to cut by June or by the summer. So, as you say, completely tramping over her prior comments. The only real dove there who sees something earlier is Centeno, who said we may not have to wait until May before we start changing policy. So for this one, again, no expectations for any action. I think the rhetoric that we've heard for the last, since January, is going to continue. That's going to be the push, that they are needing to keep rates higher for longer, and they're not going to go with any early cuts.
Good stuff. I just want to read out a quote. I think it's actually an early contender for quote of the year. I think my disdain for Madame Lagarde is probably quite clear at this point, 4.5 years into her tenure at the ECB. But this quote has come from an anonymous ECB staff member, and it just sums it up for me. And it goes as follows. And this is according to a recent survey that's been reported by Politico. I'm not making this up. And the quote is as such: Mario Draghi was there for the ECB, while the ECB seems to be there for Christine Lagarde. And I think that sums the situation up very well. But before I get myself into trouble, why don't we go back to you, Ryan, for some sage trading tips?
Yeah, well, just this is going to follow on. I spoke last week about the low volatility we got in markets, especially in FX. And it's become apparent, certainly among more than a few of us in our community, that such low volatility is becoming frustrating to trade. So if it's becoming frustrating in my circle, I'm sure that frustration is widespread for a lot of traders. So today I wanted to try and offer some advice on how to navigate markets that are stuck in tight ranges or moving slowly. So if we look at something like euro dollar this year, it's had a 201 pip range, basically, and it spent most of its time gyrating around 109.50. So no matter what's been thrown at it, the data, central bankers, meetings, squawkers, geopolitical events, it's been stuck. So the best way to trade this is firstly to make sure your expectations are realistic. There's no point making a short-term trade off a data point, headline or technical level, and then setting a target that matches or exceeds the year's range so far. What you need to do is manage a trade as it goes. Myself and others like the slice and dice strategy, where you get into a trade, bank some as soon as you maybe see 10, 20 pips profit, and immediately start to pull your stop up closer to entry. And when you do this, it can often get the trade to lower or zero risk quickly, which should obviously be the first thing intention when you're trading. Then you can try and take more partial profits if the price goes your way, again, moving the stop up each time. And doing that means that if a trade goes your way but then runs out of steam and reverts back to a mid-range level, you have a good chance still of making money, or at least losing much less. But what this strategy does give you is the opportunity to catch an outsized move if one happens, a move that perhaps breaks the range eventually. That means you can maximize your potential profits. So all traders need to trade the conditions the market sets us. And if that's slow and boring, then we need to trade a method that potentially gives us the best chance to make money from those conditions. So always adjust your trading to what's happening in the market.
Yes, incredibly well said, mate. I wouldn't really have anything to add to that at all. It's although I would definitely echo your sentiments in that it has become quite dull, to be honest with you. And, even in the office, we've been talking about how low vol is and how markets are just stuck in a little bit of a range, and particularly in the FX space. I mean, it feels like weeks now that, as you said, we've just been sat there going, the euro's at 109, cable's at 127-ish. A lot of G10s just haven't really done a lot to start the year. And I think you're absolutely right. It just speaks to the need to set realistic expectations and, importantly, not go chasing moves that, might not be there or that are unlikely to pan out, if I can get my words out. And also it's where things like implied and realized volatility measures, and even slightly cruder ways of looking at the market, just looking at a high-low range, just take all of that information on board and adjust your trading strategy to suit the prevailing market conditions, and ensure that you're not ruining your account in a quiet market, which could then potentially in the future mean that when volatility does pick up, you're unable to take advantage of that.
Yeah, because even with quiet markets, there's opportunities to make money. It's just maybe on a longer time scale. You've got to wait a bit more, have a bit more patience. But you're right what you're saying. It's very important that if you feel yourself getting frustrated, you're coming in, you're spending time in front of your computer, maybe you're not full time like us, so you're doing it in between a job and you want to maximize that time. It's important that you don't let that frustration get into your trading and start making trades that you think are going to go somewhere they haven't been for 6 weeks, and just getting out your comfort zone, getting into positions that 10 minutes later you think, why the hell did I do that? Patience is a big part of trading. If it means you don't do anything until you get the right levels, you've got to work hard on that to sit on your hands.
Absolutely. As they always say, having no position is a position in and of itself. And there is no harm in, getting up and leaving the desk and going for a walk or a change of scenery or whatever it takes just to reset your mind and make sure you maintain that focus. You need to find what works for you. Right. Well, what we hope is going to work for you are some setups, which is exactly what we're going to show you next. That was a good segue, that one, wasn't it? I'm proud.
Yeah, very good. Very smooth. Very smooth. Makes a change.
Smooth, and it wasn't even rehearsed. Right, let's roll on to our first setup, which is mine. I'm going to be looking at the Swiss franc to kick things off this week because the Swissy has had a bit of a torrid time of things of late. Let's put it politely. We've had, last week was dollar Swiss's biggest 1 week advance since June of 2022. And actually, the Swissy has now lost ground for 7 and is actually looking to make that 8 days at the time of recording, which is the worst run for the Swiss franc since September of 2023. I'm not sure why I can't speak today. So not only is momentum in favour of the bulls at this point, the technical side of things is also starting to point towards further upside in dollar Swiss. There we go again. Friday saw our first close above the 50-day moving average since last November, which for me puts the 88 figure on the cards to the upside as the next level to watch. And then you've got the 100 and the 200-day moving averages above that, around 88.50. I think the other thing that's interesting here is actually the fundamental side of the equation, and that is that we heard from the Swiss National Bank chair, Thomas Jordan, towards the tail end of last week, and he was flagging some concern around what he called the real appreciation in the Swiss franc, real, of course, being inflation adjusted, and how that was starting to pose some deflationary headwinds to the Swiss economy towards the back end of last year. And I think just at the margin, particularly when you consider that the SNB only meet quarterly, that could just increase the prospects of perhaps a slightly more dovish outlook from the SNB over the course of the next few months. So personally, I favour further upside here in dollar Swiss. And actually, if you want to pull up a chart of euro Swiss, they both look pretty similar at this moment. And I would certainly rather play it against the dollar because I'm relatively bullish on the greenback at the moment. But if you have a strong view on the euro, then there is another way to get exposure to the theme as well.
Yeah, this is a popular trade at the moment. I know a lot in our community are trading it this way as well. I have got some bad news for you though, mate. Citi were out with a piece today saying they looking at they like short Swiss as well. So that's your contra signal right there. So you probably want to scrap this altogether, but too late. We've recorded it. So everything's going the right way at the moment, as you say, Jordan, indicating that this trade is going to go the right way. You can never say never with that mob. The biggest manipulators there are trading both sides of the trade as well. So yeah, it's looking good. We are just struggling at this 87 level initially. So the big figures coming into play there, as you can see on the chart, there was a former support and resistance point recently. So yeah, you need to get over these speed humps. Get over 87, then you're probably going to be 88 not long after that. But if it doesn't get over that hump, then longs might be worried, and you might see a few head into the hills, and that might give us a bit of a steeper pullback, which I'm sure the dip buyers will come right back in. So, carry on. The trend is your friend.
Indeed. Well, there's one consensus trade. What's the other consensus at the moment? Long Japan. Why don't you take that one away as well?
Yeah, I will do. Long Japan. There's no stopping this one. And it seems Japanese stocks are leading the way. We've got the Nikkei up at 34-year highs. Real huge move we've got going on here. Now, there's a host of reasons why stocks are booming here, including, some opposing thoughts that sort of lead to the same outcome anyway. As we mentioned earlier, in the global setting, stocks are responding much alike to the fact that rates have topped, but that's coming even while Japan hasn't even started hiking yet. So what marks the difference? Well, on one hand, we have the prospect of higher wages bringing higher rates. So we have potentially better domestic economy leading to increased profitability for firms. Higher rates also brings optimism for higher profits for banks and financial institutions. So on the fundamental side, Japan finally managing to drag itself out from the deflationary mire is an actual boom for stocks as firms undertake buybacks and domestic and foreign investors, look for opportunities. On the other side, though, we still have the Bank of Japan, who, while they are saying they're on the path to ending easy policy, there's still a few speed humps to get over. And perhaps the time frame for doing so might need to be a bit stretched out further than a lot of people expect. So in a situation where there is a lot being gambled on higher wages, and all while inflation seems to be coming back down, it means the BOJ will keep easing and their finger hovering over the ETF buy button as a support measure. So technically, the sky really is the limit here, but there's a couple of spots to watch from the long-term charts going back to 1989, 1990 highs, up near the 38,000, 39,000 area. That may provide a stall point for this move. While on the downside, the break point around 33,800, 34,000 is where support needs to hold to keep this move alive. So quite a big range to trade there. We are in sort of territory we haven't traded for a long time, and the tech is few and far between up here. So we do have these big levels. They're going to be your gauges for whether this move continues or if we pull back and move back down again. So lots to watch for this one. Bit of a popcorn show, really.
Indeed, yes, there is a lot to watch. I like long Japan, actually, at the moment, for another couple of fundamental reasons that you didn't mention, which I will just go into very, very quickly. The first is that people, institutional investors, everyone else, want exposure to Asia, but they do not want exposure to China for fairly obvious reasons. So they are buying Japan instead as almost a proxy for that. So that is likely to result in some fairly chunky inflows, and I think it is probably already doing so. And the second is something that's been going on for about a year, 18 months now, and should continue for the next year, 18 months, which is the ongoing corporate reforms that are taking place in Japan. There have been a lot of long-running efforts from the Tokyo Stock Exchange to effectively try and get companies in Japan to listen to their shareholders a little bit more and try and improve the profitability of firms within the country. I actually wrote about this at quite some length a couple of weeks ago, so that's on the website if you do want to have a read of that. But in short, there is a big push to increase the profitability of firms and to increase the amount of capital that is either reinvested in the companies or returned to shareholders. And I think that is also likely to help boost equities in the country as well. So yeah, this is a bandwagon, this consensus that I'm happy to be riding along with for now.
Yeah, and I think there's something else I recall where they've introduced some new rules or changed the rules for investments for people. I think they've got a similar thing to what we have over here with the ISAs. Well. Yeah, so they've increased the limit you're allowed to save without paying tax. So that could be kicking in the early part of this year and getting domestic investors just putting a little more in their savings portfolio. So yeah, again, there's lots of potential rebalance. I won't call rebalancing, but reallocation, as you say, maybe out of China coming into here and other stock markets. So yeah, it's some big levels to watch and some interesting times ahead.
Indeed, yes. Jeremy Hunt, if you're watching, tax cuts, look what they can do to your market. Take note, mate. Right, let's have a look at the dollar. I wanted to just have a quick look at the dollar and just overlay it with treasuries. We talk all the time, or I talk all the time, let's be honest, about the bond market and the impact that it has on the FX space. And I think that is really, really shining through at the moment. And this just helps to visualize what has perhaps been the main or even the only driver of the dollar strength of late. And that is the fact that the dollar has been moving almost tick for tick with treasury yields, both at the front end and further out across the curve. We're looking at 2s and 10s here. And I think this just shows how it's primarily policy expectations that seem to be running the show in the FX space at the moment, with the dollar having advanced as treasuries sold off and as yields have risen across the curve. Although perhaps we're starting to see that just detach a little bit today in early trade, although it has been a couple of hours since I made this chart. The other thing that I would say is that actually when you compare the dollar to what's been the main driver of the rally, it doesn't really look like that move is particularly overextended. We haven't got one line massively ahead of the other, to put it in very, very crude terms. And what that says to me is that actually if we do see this hawkish repricing continue, the market's still pricing about 12, 13 basis points of cuts for the March meeting, and of course 60 basis points more than the Fed's dot plot is implying in terms of cuts by the tail end of the year. So if we were to see that hawkish repricing to continue, to me, this implies that actually the dollar could have more room to run to the upside, even though we already touched new year-to-date highs in the dollar index towards the tail end of last week. And of course, if we were to see that take place, then you'd expect that move to be concentrated against the lower yielding areas of the market. And again, that puts the Japanese yen squarely in the sights of dollar bulls as we near that 150 mark once more in dollar yen.
Yeah, I absolutely agree with that. And the good thing about watching something like this, apart from the fact you're watching a Dixie chart, which I have absolutely no interest in whatsoever, is that you do get
knew someone was going to moan about it. I just knew it.
It's witchcraft. It's when you get those divergences, because you've got to remember that the dollar index is obviously a basket of currencies. So plenty can happen in the Eurozone, plenty can happen in Japan, in the UK, wherever, that will affect what happens, not just on the dollar side. So when you do get these divergent plays, and one of them is, we've seen recently, obviously with the yen having a big input on what's going on over there, that can give you opportunity, because when you get correlations like this that generally move pretty close together, you suddenly get a divergence there. That's a potential opportunity to trade. So I agree with what you're saying on that front. The yield situation is something else as well, because again, yields are seemingly all following the same pattern. But I still think this year is going to be another big year for divergent trading between the central banks. Like you said earlier, we've got the Fed pricing in, or the market still pricing in 5 odd cuts from the Fed. We've got pretty much the same from the ECB, but there's near enough 1.5% percentage points difference between the two rates. So you've got that difference that not many in the market take into account. They think, oh, the Fed's going to cut 4 times, 5 times. ECB is going to cut 4 times, 5 times. Well, they're different rate levels. So maybe the ECB isn't going to cut as much as the Fed are going to cut, because they're all going to get down to a rate, a neutral rate that's maybe, I don't know, 2.5%, 3%, which means the Fed are going to cut more than the ECB. And I don't think that's being reflected in these sort of charts at the moment. And I think that's where you're going to get the bigger trading opportunities. So, yeah, by all means, it's a great setup to look at, but just factor in the other currencies and the other central banks in the picture as well.
Yes, that is a very good point. I will happily take the other side of your ECB cutting more less than the Fed bet.
Have we got a bet on? Have we got a bet on?
It's a shame Marcus Waring's closed his restaurant, isn't it? Particularly when you've got the ECB running around last week. I think it was Villeroy saying that they think R star is at 0 in the Eurozone. So I think that's important to bear in mind. In any case, we won't go into all the geeky monetary policy stuff this week. The dollar index, for all its flaws, at least it's moving around, which is more than can be said for what you've chosen to talk about.
Oh, that's a low blow, mate. Very low blow, that one. But yes, I'm going to talk about one of your favourites, cable. We had a big week of data and stuff last week. It came through all that with this 126, 128 range intact. We had a look at the downside, and we finished the week pretty much bang in the middle, around 127. So now, while I wasn't up early enough last week to catch the move for 126 right down into the big figure last Wednesday, I did decide to pick some up when we got the US CPI data, giving a little dip there. It seems like cable would be one of the better contenders to bounce back after that US data and reverting, as we said, to the middle of the range. Now, it remains to be seen if we can manage to put in another test on the upside towards 128, and I'm holding my longs to see if that happens. I'm already using the slice and dice strategy that I highlighted earlier. Just before the show, I got out a bit more at 127.27. But now, while these ranges can be great to trade, one has to remember that at some point they will break. And in cable, a 200 pip range is a very, very tight one. I'm surprised it's lasted this long. So with that in mind, the more tests and holds we get of these edges, the more I will start to look at setting up for a break play. As I say, one is going to happen at some point. Now, in that scenario, I'd be looking for a test of at least the low 125s for a downside break, and up to 128.50, 70, 129 on an upside break. Now, while the fundamentals are important for trading any currency, there's times when you can just trade the price action regardless of those or any bias or sentiment you may have. So just trade the levels. You don't have to have a view of the market in this one or view of the UK. We've got a good setup here, a good range. Trade the range, trade the breaks.
Oh, you do? You can't deprive me of having a view on the UK economy.
Don't need to put the coffee on.
No, so I'm just shocked that you weren't up at 7 o'clock in the morning for that data that came
out.
No,
I'm still on strike. I'm still on strike for 7 a.m. data. I refuse to do it until they put it back to 9:30. I'm ignoring it. I don't care if it moves my positions at 200 pips. I'm not getting up for 7 a.m. data.
We're in our 4th year of that strike now, and sadly, I don't think the ONS are going to listen. Right, I'm going to win. I'm going to win. A train driver, right?
Yeah, they're still on strike, aren't they?
Oh, yes, they are. Yeah. As long as you don't go on strike from co-hosting this show, we should be fine. My view on the UK economy is, and the pound is the same as it always is, which is quite a pessimistic one. And I won't bore you all with it once again. What we will do instead is we will get on to our plays of the day for this week. Right, my play of the day this week is to go all the way down under to New Zealand. I've got to be careful because I think the last time I spoke about New Zealand on this programme, I annoyed a few people. So I will try not to do that once more this time.
The letters are still coming in about that one.
What, from the sheep?
More letters are going to come in now. He's done it again. Oh, I give up. Nothing to do with me, folks. It's all on him.
I will fully own that one. Right. We spoke about some of the antipodeans last week. I spoke about the Aussie dollar, and we flagged some downside risks there. And actually, the Kiwi dollar is pretty much trading in line with where the Aussie dollar is going. Failing to join in with that risk-on rally that we're seeing on Wall Street, and still facing some pretty stiff headwinds. I think dismal sentiment towards China is perhaps the biggest driver here. And we've now fallen all the way back from those 63.80 highs that you can see in the red line on the chart, which we've tested pretty much 4 times now and rejected pretty much every time. And we've come all the way back down to both the 61 figure and the 200-day moving average. And that's a very, very important level for the pair, which has held firm as support since all the way back in last November and December. So I'm going to be looking for a short here if we can get a closing break below. We've held it for 3 straight days now. So if we do get a break, it could be a fairly sizable one. Initially looking to run this down towards the 60 figure. And I think the key thing to watch here in terms of data is the Kiwi CPI print that we've got coming out on Tuesday evening here in the UK. The market currently pricing its first cut for July, which is a little bit later than some of the other G10 central banks out there. And I think if we do get a cooler print, we could see a bit of a dovish repricing, and that move could gather a little bit of pace to the downside if that 200-day moving average gives way. Ryan, you're talking about the S&P this week, I see. Yeah,
I'm talking about the S&P, and I'm keeping half an eye on my trading screen because I might have to get out a bit more of my longs. We're moving up again, but this was my play of the day last week, and it was to try and get on a break of the 4,800 highs. And I had to wait until Friday for it to happen. The break so far has been pretty decent, but it remains to be seen whether this is going to continue. There's always a big element of the unknown when asset prices move to new all-time highs or lows, because there's no old price history to present us with tech areas where price may stall and reverse. Therefore, it becomes a situation where we have to see where the price action develops those levels, i.e. in this case resistance levels, and at the moment it seems like it's not stopping anywhere. When we do start to see a period where, maybe a few sessions where we make a high, then we hold that high, then we make just a lower high below that, that's the time you want to be looking at if you want to fight this move, to look at potentially going short, or if you're long, to take more profit off the table. What I'll also be doing is watching any retest of the big break point. That's down at that 4,800, 4,820 area, which should now hold as decent resistance. And if it does, I'm going to be looking to add back into my longs the bits I've already cut already. Otherwise, I will have to let the market show me where the levels are going to appear over the next few sessions and then decide what I want to do with this trade. But at the moment, it's the break is looking pretty decent, and I see no signs of it stopping just yet.
Indeed, and I certainly agree with that. In that case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as well, as he always does as well. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if you have any specific grievances that you would like to air with me, or even say that I'm AI generated. Whatever you want to put, the comment box is open. Hopefully you've enjoyed the show and there's been some value in there for you. Myself and Ryan will be back to do it all again this time next week, and we hope to see you then. In the meantime, thanks very much for watching, and goodbye for now.